Hello, everyone. Welcome, everybody, to the latest CTO Craft Bytes. Today, we will be discussing bridging technology and business, how tech drives outcomes. I'm Hannah Van Nostrand. I am the Senior Content Manager here at CTO Craft. And if this is your first time at CTO Craft Bytes, I'll tell you a bit more about what CTO Craft does. So, we provide a learning and mentoring community for senior technology leaders. We have a community of thousands of leaders, annual conferences, mentoring groups, one-to-one coaching, and our community membership is free. So if you like what you see today and you're leading technology teams, you should definitely get involved. So you can add your questions at any time during today's conversation using the software. There is an ask a question section. And we will cover these during the discussion and afterwards as well. The session will be recorded and you can rewatch on this platform. So without further ado, I'm going to hand it over to Will, who's leading today's conversation.
Thank you, Hannah. Thank you, everyone, for joining us today. Appreciate you taking a bit of time out of your day for this conversation. So my name is Will Lytle. I'm the COO over at Plandeck. If you've never heard of Plandeck before, we're a software analytics tool that connects to a variety of different tools you use throughout the software delivery process to provide insights to organizations on how things are doing, what you can do well, what you could do better, and so on and so forth. So I'm joined today by two gentlemen who are going to help kind of walk us through the topic for today's conversation. Darren Thorpe, I'll let you go first if you want to make a quick introduction of yourself and your business.
Sure. Thanks, Will, and hi to everybody. My name is Darren Thorpe, and I'm Chief Product Officer of Private Equity International. We are a data, editorial, and events business with 18 different titles that serve up a mix of editorial or data and associated networking events. We almost exclusively serve the private equity industry, focusing on various asset classes that exist within that industry. And business size is about 500 people. And whilst my role is Chief Product Officer, having been a CTO in a previous life, I'm also responsible for data engineering, data science, product engineering, as well as all the more producty functions.
Fantastic. And Ray Dogra joins us as well. Ray, do you want to give us a little bit of a introduction, bit of your background as well?
Yeah, hi everybody. So I'm Ray. I'm currently the CPO at Plandeck. So I won't go through the company overview again. Will's done that in spades. I've been here about 4 months, and pre Plandeck, I spent about 5 years at HSBC in a variety of product and technology roles there. Before that, about 10 years founding and investing in various smaller technology businesses, and then before that, about 17 years at Accenture. I was a partner in the telecom, media, and high tech practice. So I've sort of had a career over 30 odd years, straddling technology and business and commercial roles. And at heart, I'm an engineer by training and stuff a long time ago. That's me.
Fantastic. And yes, as Hannah mentioned, we'll be doing a kind of a panel open conversation today. If you have any questions, I'll be monitoring, so please feel free to ask them. I'll try to incorporate into the conversation. It'd be great to have a bit of an ongoing dialogue conversation that incorporates today's audience as well. So I encourage everyone to submit some questions. I think we'll start off with you, Darren. In the context of mapping and understanding how technology links, enables business outcomes and how you deliver it, how do you guys at PEI start to think out how you even map this idea of value creation from your business planning all the way through to your technology delivery?
Yeah. Okay. Straight in with a big one then. So for anybody that's been through the kind of private equity ownership cycle, you'll be familiar with at least the first bit that I'm talking about. We were bought in January of this year, and we go to market with a value creation hypothesis that says where we think the market opportunity is. When the new buyer comes on board, that value creation hypothesis gets elaborated in a lot more detail. And it will say which markets we think we're underpenetrated in, where we think there's white space, if there are any acquisitions that we need that look interesting, and that sort of thing. So at a very high level, the business knows what it is doing for the next 4 to 5 years. We know the cardinality of which way we're heading, right? Everybody knows that we're going east. There may be some variation along the way, but we know where we're going. So that's everything then gets linked back to that. If we're proposing extra capex spend that is not linked to that, then the bar for getting that over the line is incredibly high. But once that value creation plan is in place, I can tell you more about what we've done at PEI. We've organized our product engineering and to some extent our research analytics, sales and marketing teams into value streams. And our value streams map onto the customer segments that we think exist in the market. Then each value stream gets allocated at the beginning of the year the amount of capex spend that we think is appropriate to pursue that market segment. As we roll through the year, the product managers that are working within those value streams go through a process that, if you're familiar with lean portfolio management, that's pretty much what we run. Product managers will make a proposal to pursue a new product idea that supports that value creation plan. And in the first instance, they will ask for access to capacity to run a discovery phase. After they've run discovery, they will come back to the board and say, this is what I've learned. I either need to pivot, stop, or continue. If they're continuing, they're moving into a planning phase where they're getting kind of quite specific about the level of resource that they're going to need to build. Typically, they'll only ask for 3 months worth of capacity before they'll come back and ask for another 3 months. And then the final step after planning is to move into delivery and then move into production. So we have a process that takes us from proposal all the way through to production. The board has the right to say no to an idea. Its role is to ensure that all ideas are linked to the value creation plan, but it should not be at the cost of being agile and flexible and being able to move. We might say, okay, we know we're going east, but we just want to move a couple of points off the cardinality for some sprints before we come back. And what we're trying to do with that lean portfolio management process is marry these two kind of conflicting worlds that come together. The view that the owner has of, we're in a holding period for 5 years, we want to see numbers going up and tracking towards our exit, and we know what the exit value should be, versus the agile world of being able to be flexible, pivot really quickly, and react to new information as it comes in. So the way that we're trying to tackle that problem is all development is proposed using a hypothesis-based model, where we say we believe if we build X, we'll create value Y, and we'll know we've been successful when Z happens. And Z normally consists of a series of lagging indicators, which are the revenue indicators that everybody cares about, but then the leading indicators that we think are linked to the lagging indicator that we will measure at the earliest opportunity to give the board confidence that those lagging indicators will deliver.
What are some examples of those leading indicators? Are you using more business indicators, sort of product engagement stats, or what are the indicators that you use?
Yeah, so we've just released a new product at the moment, mm-hmm. And part of the hypothesis is based upon when we segment our customers on our existing platform, we know that there are some customers that don't realize all the features that exist. Mm-hmm. For the customers that do realize that the features exist, we get exceptionally high renewal rates. So we want to get more customers into that segment. So our new product is using a different UX approach that surfaces these new features in a way that maps onto the customer's work stream. So it's immediately obvious when you log in.
Mm-hmm.
And what we can see early on using Heap.io is our tracking system, is that the session time has gone up, the number of visits has gone up, and the frequency of visit has gone up. So our hypothesis is, because that's happening, if they were doing that on this other product, they would be in the very highly recurring bucket. So that's our early indicator. We're not going to know if they're going to renew until we get much further down the line. So that's our quant-based approach. And then we use qualitative interviews as well to go and talk to the customers to understand.
And to what extent do the product managers in your teams own the actual business outcomes, the KPIs, the leading indicators, not so much maybe the lagging indicators, but certainly the leading indicators, because that's something a lot of organizations struggle with is, we want our product teams to be responsible for the outcomes, and yet sometimes they do or don't own certain really critical KPIs, let's say, with leading indicators that you mentioned within the product performance.
Yeah, 100% they own the leading indicators and they're chasing those down. Most of our product managers behave like they are CEOs of their small piece of the business, and having them align to the sales outcome, I think, has really taken the brakes off. It will always be sales that owns the actual revenue, because they're closing the deals and they'll take the kudos for that. But it's the product manager that is getting them to that point where they can close, and ever so surely that is being recognized more across the business.
Interesting. And Ray, from your experience, we think about agile, right, as a capability, right, and the ways that we work and how do we evidence that we're working in effective agile ways. What's been your experience with trying to link that to some of these leading indicators or indicators of value delivery, right? Starting to cross that bridge between how is the ways that we're working actually enabling positive business outcomes, like those sort of leading indicators.
Yeah. So I really like the way, Darren, you sort of think about the sort of the leading and the lagging things, right? You've got the revenue being the ultimate goal, or the cost reduction goal is the ultimate thing, or the retention goal is the ultimate thing that you're sort of stepping back from. You then got some external facing metrics, those sort of, as you refer to, the leading indicators, which you can a bit more tightly link a product person or a technology person to. And then almost before that, you've then got the how are we getting there? What are some of the agile type metrics that might also feed into the way in which we're building the thing that gets us that outcome? And I think it's really, well, one of the things back to the overall topic of the conversation, I think a very healthy practice is to make sure that those product teams and engineering teams have those, leading and lagging indicators, as you put it, the external facing things very much there. And then the things about how we're doing it, the sort of the cycle times and the, DORA type metrics and things then being secondary to help how we're building the bits and linking in there in some way, but not being the absolute focus of those teams. And I see that as one of the big disconnects sometimes is you get tech teams in particular, and even product teams to an extent, very much focusing on the how we're doing stuff and not the what and the outcome bits are. And so you end up with very sort of delivery centric, or I don't know, value stream metric centric conversations, which then become very hard to connect to the business about, in terms of, hey, this is the outcome we're achieving, and we'll tweak the bits to it. And yes, there's some important things about how we do it that you've got to take into consider, but it's really keeping those bits that at the forefront that really matter. Highly effective teams, in my opinion, do the latter, have those business things then, and link them to the how we're doing it bits. Where teams struggle, or you struggle to get the trust of the business, is if you only talk in terms of the how we're doing it type metrics and so on.
And what has been your experience? I mean, for either you to answer, or both of you to answer for that matter, when what do you do when leading indicators do not show progress as expected? It's one of the questions that have come from the audience, which I think is a very good question, a very timely question.
Yeah, so we've definitely been in that scenario where we've had that happen, and I think this company is probably the first company where I've killed a project because of that, because the hypothesis just did not hold water once we started to get it in front of. Once we started to get our early prototypes in front of customers, we discovered that we were solving the wrong problem. And although that was, it sounds contrite, doesn't it? It almost sounds like the interview question, like what is one of your weaknesses, and you recarve it into, well, it's actually my greatest strength. But it was a great example of where agile can work, because we had that moment of realization before we'd spent a load on the product. That for PEI, which is coming from quite a way behind when I joined 2 years ago on really understanding what agile means. It had all the vernacular, it had all the ceremonies, but it really didn't get how agile works, and how having the flexibility to be able to stop and react to new information is super important.
I think just to add to that, Dan, that's an excellent example. I'll give two short ones, if I may. One from a very small business, one from a much larger one. The small one is business I invested in, co-founded, a bunch of things on there. We had our heads and hearts set on a particular feature that we thought was going to be our way of cracking a particular thing. We built it, beautifully. We convinced ourselves that we had to have a really slick UI that worked and did loads of things for it. We put it into market, and literally one person used it. And it was a somewhat expensive lesson in not testing things properly, killing things if they don't work early, or at least learning and adapting and changing early in the thing. We'd sort of made our initial thing very, very big. And the one word I'm holding back from using in that bit of conversation is MVP, because at a much larger organization, we ended up in a whole bunch of things where the language around MVP was a very difficult one. The expectations around what it was were very different. So you had business stakeholders believing MVP was version 1 of product proper, and it had to be very good and had to do all these things. And trying to convince them and trying to play back this lesson to people of, we've got to do something that we can build much. We've got to be accepting that we don't need to have all of that stuff in place in order to get something, and then to adapt it very quickly. And back to the question, to really watch for those leading indicators and measure those things and have those measurements baked in, and be actively watching them and then making decisions on it. And the decision could be, yep, we think we've got something, so we're going to adapt a bit, or it could be, as you did, Darren, we're just going to kill it. But you've got to be watching those things and adapting to them as you go through. And the language around that really matters, and the expectations you set around that, I think, is really important.
We stopped using the term minimal viable product at PEI for those reasons. It just caused so many problems when we're engaging with sales team. Invariably, we get into a conversation of, is the product finished? And then you get into a deep and meaningful of, how do you define finished? Well, the customer defines finished, so we need to get that product in front of the customer before it is finished, and there the circular argument just continues. But so we've landed on, and I don't claim that this terminology is any better than MVP actually, but it is what we've landed on. We're using first usable product and first sellable product. Once we get to usable, we know that we've got something that is enough to demo to a customer. And then at some point afterwards, ideally we're letting customers onto the product when it's usable, but in a trial mode, and then we're letting the data tell us when it's sellable. I thought it might also be useful to just share a couple of comments on team structure. So within our value stream, every value stream has a product manager, business analyst, all the engineers that you would expect in a Scrum team, but it also has product designer and UX researcher And so a lot of the insight is being run by the product designer and user researcher, who just spend their time talking to the market and listening to the market. I think that has protected us from building product that nobody's really interested in, because we couldn't call it quant-based analysis, but we get a lot of qualitative analysis out of that.
Do you do that on a one-to-one mapping, Darren? So one of those research type person per team, or do you spread them across multiple teams?
Yeah, it's one per team. The UX researcher and the product designer will pair and sit alongside a Scrum team, and the idea is that they just think about the customer segment that they're in and map out the value streams for those customers, and then we make a decision about should we build product to play in that space.
Very good.
Interesting. A lot of what we've spoken about so far is kind of more geared towards almost greenfield products, right? New products that we're bringing to market to penetrate into a certain area, large major features. For those product teams out there who are more of the, product is already in the market, we're in a kind of incremental build mode, right? We're just adding features bit by bit to try to improve some of those key leading indicators, drive more customers into, retention and upsell customers and so on and so forth. A lot of investment goes into those teams, right? And a lot of what they're delivering is oftentimes so small, it's very difficult to put a price tag on it. What is the value of a small change or a set of small changes that are continuously being released into productions, into our users' hands on a consistent basis? With that kind of an area, the investment largely is a sort of capability play, right? You're trying to build an engine that can respond to customer feedback, market changes very quickly, and continue to iterate on that product base. What's been your experience, your suggestions, both of you? How do you start to evidence the value of that investment, where maybe the outcome, the deliverable itself isn't, a very large new product, or I love the term first usable product and first sellable product. I think we might steal some of that. What's your thoughts, your suggestions, your experience with those? How do you evidence to the board and that side of things?
Well, I lean on the analytics for that to show us where the engagement is. So it's back to leading indicators. It doesn't matter how small something is, with the exception of maybe bugs. Everything is backed up by a hypothesis statement. So there's a very, very clear statement from the get-go of, we're going to do something and it's for this customer segment, but we know it will be successful when this thing happens. And if we can evidence that thing, then it will, continue to exist. One thing I did do when I joined PEI was once we got our analytics in, we did an audit of our existing solutions to show feature by feature which are the things that people are engaging with. And sure enough, the platform had been in for years, a bit like Outlook, just tons of features that people were not engaging with. And playing that back to our management team of maybe the engagement back in time was better, but if we were looking at it today and saying that level of engagement was representative in days gone by, we would be looking at that and saying, well, that's wasted capex. What was the opportunity cost of delivering that without focusing on the leading indicators? That's can come full circle. I've had to confront situations with new product launches where I've felt, gosh, I think we're super lean on what we're putting out here. But I think it's really important for all of us to confront our own biases. Having been working in this market for nearly 10 years, I maybe have some right to claiming that I understand what customers want, but nonetheless, I do carry bias. And so charting the shortest possible route from idea proposal through to that first leading indicator, that's what we focus on at PEI, to make that route as short as possible. Once we get to the quant data coming back, then we can all breathe a bit easy.
Yeah, just to add maybe two things on that. On the working with the more established mature products, I think sometimes the the distance actually can be shorter between the leading and the lagging metrics on there, right? So because you may have, depending on what the thing is, you already have some revenue directly attached to it. So if you increase, do a couple of things, increase conversion rate slightly on this thing here, that will probably flow into revenue faster than having to go and create new markets, new segments, or whatever thing. So sometimes it can be a little bit sharper on there. The other thing I would say is I think the other thing that again, touching on maybe a topic for later in this conversation, or another sort of theme around communicating with business, the, the investment choices you might make about putting money into a more mature product versus a newer product are probably a little different. So if you think about some common buckets of things you might have, you've probably got for any product line, you've got how much money are we going to spend on actually genuinely building out new features with a discovery process and real learning? How much are we spending on more sustaining type innovation? So things we're just optimizing around it. How much are we spending on technical debt and cleaning things up and just making it some of the performance things work a bit better? Your profile of investment is probably quite different on a new thing versus on those old things. And to be able to communicate that very succinctly, I think, to business stakeholders and especially board financial stakeholders, I think really it's just a really powerful way of really showing that you're very attuned to what matters to them. So you are not treating everything as the same. We're doing just as much, our investment profile on product A is the same as on product B, but showing you understand the nuances of where these things are in the life cycle, and you're adapting your investment and you're making really good use of scarce resources around that. I think is a really powerful way of just showing, hey, I'm in those conversations. I'm not just worried about doing the best technology we can do.
Yeah, and that actually leads me on to one of the next questions I had for you, gentlemen, because a lot of technology leaders have, oftentimes have a very difficult time evidencing the value of tech debt. There's some tech debt which has a direct correlation. Say, for instance, if we work on this bit of work, it might optimize how we're using AWS and have an immediate impact on the reduction of our AWS hosting costs, right? That's kind of a dream come true because you can draw a direct line to what the business case is of investing in this particular area. A lot of that doesn't necessarily have a direct correlation with a cost line, right? More platform enablement, performance base. How do you, and Darren, maybe this is a good one for you to start, because are you using your leading indicators? To what extent are you using leading indicators as a way of being able to evidence the value of technical debt? I know it's quite a broad question because there's a lot of things technical debt could be, but what are some suggestions that you would have to folks here about how they would start to think about evidencing technical debt that doesn't necessarily have such a direct line to things like cost savings?
Yeah, technical debt is probably not a term that I would take into the boardroom. The types of people that I'm working with in our board aren't technical, and so very often I find myself leaning on some sort of crass analogy to explain where friction is hurting us in the business. So, for example, one of our board members is a keen cyclist, and I just happened to say to him, "How's your bike feel the day after you've had it serviced?" And he's like, "Oh, it feels like brand new." I said, "Yeah, that's what our engineering team want to experience whenever they're building software." And the trouble is, as time goes on, just dirt gets in the mechanics of the system, and we want to periodically clean that out to keep ourselves match fit. But that's a great analogy, but that's not going to convince them to spend any money on removing tech debt unless we can explain how removing that debt is going to increase the pace of delivery within an organization. So for us, this was one of the times that I used Plandec data. We had a rather complicated tech stack with some new technology integrating with legacy technology, and by using Plandec data, we're enabled to measure the cycle time for different layers of the technology layer and isolate out the cycle time for our new tech layer versus our old tech layer. And what we're able to see really clearly once we've got the numbers out confirms everybody's gut feel, was that the old tech was costing us more than twice as much as the new tech, and we were able to measure that and evidence it in a way that enabled us to talk about how we start to re-platform with our board without using the phrase re-platform, because that strikes fear into any board member. It's got massive expense written all over it. So by evidencing the numbers that we're able to, we were talking about operational efficiency, and then talking about the next product that we build. It probably isn't going to come any quicker than doing on the legacy technology, but the next 2-3 products after that will really benefit from that investment, and will be delivered quickly or quicker. And we already had a view of what those products would be. We knew that the investor was already excited by those products. So being able to talk about pulling those in, and also starting to talk about, we know we're going to sell in 5 years' time, 4 years' time. We know that the future buyer will do an audit of our technology stack. And we know that if it's not clean, it's going to knock some points off the enterprise value of the business. So acting now will save us money much further down the line. So that's also been helpful.
I'll answer, if I can, just slightly differently, Darren, because I think there's always fun with a little bit of disagreement on panel. I actually find sometimes using the word debt with the board, the non-technical audience, sometimes helps a little bit, because they understand financial debt, right? We all do. Depends how big our mortgages are as to how acutely we feel the financial debt sometimes. But yeah, the idea, if you don't do something now, you're going to have to pay to service that further down the line. And I really like your point on, if it comes to a sell event, that might be the point you pay. But it's also just throughout the day, or throughout the cycles, we're having to spend more time fixing bugs because we haven't fixed these things that are there. The engineers are taking longer to build certain things because the tools and stuff they haven't got there, or the environments aren't there for that. So if you can show that there's an ongoing cost to servicing this debt, and we can choose to pay some of it off a bit early, and we need to have some, because we spend all our time servicing it. If our debt to equity ratio is wrong, it's very hard. So I think that the notion of there is some to be done, I find quite useful to get across. But people get that instinctively, and the fear then is, okay, how much and how long is it going to take to do, and when do we see the return on it? So I think trying to show, okay, we're spending this much time fixing these things and this much time building out the new roadmap, and it's a balance. And depending on where the product is in the life cycle, it's a different balance. And this course might be a different balance to this other thing there. I think can be helpful. That sort of ongoing education, if you like, of we've got to pay a bit off, we're going to see some return on it. If we don't see any return on it, then we're going to stop, or I'm going to stop you from doing it. I think is helpful. Just looking at one of the questions in the chat, I agree it's hard, and I think it's got to be, for me anyway, it's if you've got people in that ongoing conversation around, we've got to be paying a bits off, and here's how it can help do that. One example, I did some work a couple of years ago in the travel sector, looking after a couple of teams, actually on a contract basis, and we had one, web teams and mobile teams, and the web team we hadn't invested in the platform for a long time. It was if you just at time, just looking at how many tickets were being used, were teams working on over a cycle based on fixing incidents versus building out all the things the management thought they were meant to be building. It was just so skewed towards one. So you could quite clearly see we are spending 20% of our capacity building new stuff. This is why nothing's getting done there. Giving me more people isn't really going to help. I need to stop, fix those things. Only then can I then start to give you a promise of things going faster, and using that to buy a bit of latitude for doing stuff. So it's hard, and it's not a one-shot fix. It's an over time thing, in my experience.
It takes us actually really nicely into the next topic for today, is strategies for articulating technology's value to executives, to a board, fundamentally, presumably a generally non-technical audience, right? People who've come from different backgrounds in technology delivery, and so it's sometimes very difficult to express it. Bounce over to you, Darren. What are some of the tough questions that you get from the board, or the ones that you find sometimes difficult to? I like the idea of the metaphor with the bicycle, for instance, but questions like that, where you have to sort of change tack on how do I explain this to somebody? Because if I explained it literally, we're not going to get anywhere.
So for us to get to even entertain the idea of replatforming, we had to, I've said it already, really, it would lean really heavily on the leading indicators and the data that we got out of Heap.io. And so what we were looking for there was a correlation between product engagement and customer retention. And what we discovered was there are some very key themes that link those two hypotheses together. And then what we're able to do through incremental development is push more people into that highly recurring customer group. But it was only possible to take that so far. Once we got the board hooked on that, then actually said, okay, well, you're at X%. What's it going to take to get it to Y%? And that's when we had to have the conversation about, okay, this technology, we've pushed it as far as we can. It's now time to switch to this other technology, which, by the way, brings a bunch of other benefits with it. It's fully secure. It's reusable. This will perform at a level that our existing technology can't, which will support our Google page ranking, which will support our SEO ranking, which will lead to more top of funnel opportunities. And if you follow it through, we should be able to see the end of funnel revenue coming. And invariably, then we go back and we have another discussion about, well, how do you know that that's going to happen before you get to the end? And that's where the lean portfolio management process comes in, of having the regular stop points and asking at every step of the way, are you doing the smallest possible thing that you can do to prove or disprove this hypothesis? If you are, then yes, carry on.
Anything from you on that, Ray? I've had the pleasure of joining you in a couple of board meetings, but what are kind of typically the traditional tough questions that you get, related to from the board?
Yeah, I think our board's very nice. So they're lovely. I have to say that for the purposes of the tape. If I think about if I step back for a second, if I think about like what the purpose of a board is basically to guard the shareholders' interest, right? It's different from management. The board is about we whether it's private equity business, whether it's public markets, have put money in entrusting money to management to execute a plan. So the number one thing I want to know is, have you got a plan? How did you get to that plan? And what are the things you've done to figure out what's there? How are we doing against that plan? And invariably there'll be bits that are behind. So what is it we're doing to get back on plan? And if you're lucky enough to be on plan, then to get ahead of plan, right? Because we're always going to try and push for more. And then your job on the board side is to sort of, to stretch thinking and to, hopefully give some input on to remedy it. And, if you're, and I'm sure, all of us on this call at some point in our careers will probably be on a board somewhere, right? On the other side of the fence, not in management, but on the other side. You've gone from player to player management to now you're the coach. And you're trying to advise and push on it. And it's really frustrating. If you've been an operator before, you will find it incredibly frustrating because you haven't actually got that many levers to pull to do things. So I think it's all questions around that. It's questions around, have you thought this thing through? What are you doing about X? What are you doing when you see these things? And I think if you can come back with, data to a large extent of showing where you are against these things and showing that you really understand what the board's caring about, that's the number one thing to do. And also acknowledging that we've got so much data on this thing right now, I've now got to use judgment to go beyond that. And I think the interesting thing we have in technology is very often boards are exceptionally good at diagnosing sales problems, right, or trading problems or other operational problems. They will know that conversion rates down this funnel are going from A to B to C. Therefore, you've probably got a problem at stage B. Therefore, what are you doing about that? How are you talking about that? Technology is much harder because a lot of board members will not have that depth of understanding. So putting things into terms that they understand, and then helping guide them through that, and showing those, yes, we're focused on these external, metrics, but here's how the things I can control in my area connect to that. I think is the trick, to do that.
I guess on the back of that, what role does ROI play in your conversations with the board and with fellow executives about technology investments? What have you found is effective ways of being able to measure it? Particularly kind of, again, less greenfield product development where you're sort of taking capital to invest in this particular thing, which has a particular financial outcome in terms of new revenue. That's sort of an easy one. It becomes much more murkier when you're actually building and supporting and investing a continuous ongoing product in more of an iteration stage. How have you, what's been your experience there, and what's your thoughts?
I guess one of the questions that, slightly going back to the previous question, one of the questions I get at board is, how do we know that the engineering shop that we've set up is running as efficiently as it could be? And the plan deck data that you guys share has been particularly helpful with that, because it comes with an external view where we're able to evidence through that how we compare, albeit on a relatively small scale, but much better than we can get anywhere else, how we compare to other players in the market. Then we measure cadence of delivery. We look at our cost. We have a very crude metric of cost per feature and factored into cycle time. That's that kind of stat. Then on the product stat, we have a 3-part metric that looks at customer activation, customer engagement, and then customer return rate. And those two live alongside each other as, or if you could imagine a line chart showing those over time. The board is interested in how is that trend developing? Can we see continuous improvement in both?
Yeah, I've got a huge amount more to add on that. One thing I'll say, and I'll give this more from a sort of, very large company experience, so big bank or big telco type experience. The thing that gets very hard, I think, and if I'm gonna, I'm not gonna give an answer because I have one brilliantly after many years. The very hard thing, I think, with some of those big things is attributing costs correctly to things, and therefore getting true ROI. Because I think, to you're describing, Will, or the way you frame the question up, if I'm building let's say I'm building a feature to, I don't know, sell into the US market, for example, right? Or, sell into a particular market, I can kind of fairly easily attribute things that are done for that to that back to a sales target, and then the associated leading indicator targets for there. It's where I've got something that's evolving an existing thing, say to, I don't know, reduce network operation cost in a telco, right? There's tons of different things that will impact on that. And saying that this feature here or this thing here we did impact that probably requires a whole bunch of assumptions on cost allocation that will basically make or break the business case around that. So I think the thing I've found useful over time is, but for big things, it's a business case of some sort, and having a clear ROI on that. But then being a little bit depending on whether you're buying or selling, loose or flexible around just how tightly am I going to try and allocate costs and things on there. And I think working with finance in particular to agree the ground rules on how you do it so that they're consistent across the piece. Otherwise, you end up spending so much time trying to generate really elaborate cost allocation mechanisms that ultimately can be prodded at and broken. It's working with finance to try and agree the rules, and then having a collective acceptance around some of those things.
Okay, fair enough. In terms of your communications internally, right? A lot of technology leaders obviously have a responsibility for engaging with the board or other executives on these conversations. You have an entire engineering function which you're running. Many of the conversations you have are sort of fundamentally different in terms of financial outcomes versus sort of performance, engineering performance delivery outcomes. How do you tailor your technology communications to resonate at different levels in the organization, from boards down to engineering teams?
Well, I from the board level down, I try to talk as little technology as possible at the board and talk about benefits more. There's we're all prisoners of our own experience, right? But for me, I've always struggled once I get into a tech conversation in a board, because you've got a lot of people in the room and you've got to see if everybody's keeping up. So can be a tricky conversation to manage. So focusing on the benefits, everybody can get their head around the benefits. As we come lower down the management structure, where you get to people that are just closer to technology, then it's a lot easier to have a tech-based conversation. I don't know what you think, Ray.
Yeah, I think certainly for the senior folks, it's got to be about the benefits. You know, the business outcomes, the things we're doing. I would say I'm increasingly finding, the last few years that a lot of folks, there are more and more folks who have made the jump from technology side to commercial, or indeed vice versa, right? So I think there's, I've often been in, I've been surprised sometimes being, say, conversations with senior marketing folks who absolutely get certain aspects of technology. I think there's a lot. We sometimes assume that they don't get it, right? And I think sometimes they really do. It was really interesting. Actually, Accenture for many years, catching up with one of the guys there who, one of the partners running a bit of it, and he was talking about, they've got the CEO Judy Sweet put a big thing about, you've got to raise your TQ. You want everybody to have raise their technology quotient, their level of understanding around technology, because we just want all our folks to do that. And Accenture obviously in the business of a large part of it, selling technology or technology things, but the idea of just help, in all the companies, helping just raise the TQ, I think was a really good role we as technology or technology literate folks can do to raise that and have that language amongst our commercial peers and so on around that. I think is important. The other thing I would also really say in terms of techniques for doing it is keep asking lots of questions. Sometimes we can fall into the trap of telling the story and trying to explain it and things. And I think as we do so, just tactically asking lots of questions as you're going through, and continually reaffirming understanding of stuff, and then knowing when to go a little bit more or a little bit less on things, and be guided. It's kind of the old sales technique of ask more questions and listen more than you talk. 2 ears and 1 mouth sometimes can be really helpful when trying to get these things across. I find anyway.
Yeah, you've reminded me, actually, jogged my memory. I would say never waste a good crisis as well. It's getting easier to spend money on IT security. That's not really questioned anymore.
And even better sometimes, Darren, is learning from someone else's crisis, right? If it's your own crisis, then yeah. But if it's someone else's, someone else just had a major breach or something. Hey, this is why I want to do this program. So you're not on you're not on the Radio 4 explaining or in front of the House Committee.
Yeah, and another one that springs to mind as well is that our board actually came to us and said, compared to other portfolio companies, we were underinvested in data science and AI, and they asked for us to accelerate onboarding of data scientists and just find projects to do. So that may or may not be a good idea. It's turned out happily for us, but the thing that it did occur to me there is that if you are PE owned, going back and say, well, can you help us understand what the size and shape of the other portfolio companies looks like? What are they doing? How are they measuring tech debt? How are they talking to you about this? That may be useful as well.
Yeah, and I'd even suggest to extend that out to the VCs as well, right? Because VCs are still managing a pretty large portfolio of different companies at different stages in their growth, obviously, but very much was a lot of the same thesis and hypothesis floating around, good referenceability, as well as, we've certainly benefited from that a lot.
If we're extending, can I extend just one more thing? Because I think for folks who aren't in a PE-backed business or aren't in a VC business, maybe in a big business, I think you can do the same thing. One thing we used to do at HSBC was we would show the chart, public data, of how many times we were releasing our app versus everyone else, right? So take the UK, all the other big banks, the Buckleys and the Lloyds and so on, but also the Monzos and the Revoluts and the Starlings, right? Those sort of guys with the newer platforms, and just how often were we doing it, and using that as a thing to say, well, Christ, they're doing weekly releases, we're doing monthly releases. What is it they do that we don't? Well, okay, they've got a brand new tech stack. Okay, well, maybe we should, do this, that, and the other, to think about those things if we believe that releasing frequently and all the stuff we think is good to do, we kind of need to do these investments to doing it. And I think that sort of I bring it up because I think that sort of notion of how we versus our peers is, for any level of business, super important, and will always get asked, and is exactly the sort of thing a board wants to come in and do, because that's their that's what they can do, that external bit, to push management to how are you thinking about this thing here. So the more you can do back, the better.
Yep. Yeah. And actually, it reminded me as well, I know there's a number of our customers who, one of the key things that they do to how do we demonstrate that good engineering practices result in positive business outcomes? And so you've got things like the leading indicators that you mentioned, Darren. A number of our customers use specifically deployment frequency and NPS scoring to show that exact correlation between, as we increase the frequency of deployments, we can see that that's starting to have a positive impact on the leading indicator, which should, in theory, translate into renewals, upsells, and better financial outcomes for the business. So I think it's important for a lot of the leaders out there, maybe the NPS score isn't right for your application or your business, but to try to find something that does draw that correlation with, something like a deployment frequency into a leading indicator, which then is going to have material impact on your financial outcomes, is a really great way to start to think about how do we correlate, good engineering practices enable positive business outcomes. We've got one more question here that's come through. I think I'll flag on the screen. I don't know, actually. It does. It works just like that. Fantastic. This comes back from a little bit earlier in the conversation. So sorry, Kendrick, that I've waited so long to bring this up. I just want to get in the night flow. But going back to product managers owning leading indicators, right? To what extent do you think that leading indicators should also be? So it's not only just you are responsible for the performance of these leading indicators and the decisions you make and how those do or don't drive it, but also the financially then compensated for that, in sort of a variable comp.
I've done that, specifically return rate, for products that I've been looking after on a quarterly basis. We measure the return rate, and the product manager is KPI'd against changing the shape of the curve.
I think it's an excellent idea. Whether it's all variable comp through that or not, debatable, and certainly at level, debatable. So I think if you're more higher up in the organization you are, it's probably more on the the overall business things. How are we doing overall, versus a revenue target, for example, or a retention target, your NRR, if you're in a SaaS business, perhaps target, more towards that. But I think things you can more directly influence, like some of those leading indicators, I think is a great way to just get people aligned to the outcomes, really. And I think people enjoy it as well, right? They can see that they do something. I mean, enjoy is a subjective term, but can see that direct link between, I did this thing here, my team did this thing here, it drove this outcome. It matters to the business, and therefore it matters to me.
Brilliant. So before I hand back to Hannah, I'll ask you both one question. If you have one bit of advice to somebody who's new into a CTO or a CPTO or a CIO role, one bit of advice around this conversation of what's the most effective way of being able to evidence the value that technology is delivering in terms of the business outcomes, what would be your bit of advice, whether it's communication or strategy or mapping? What do you think is kind of one of the the most important takeaway for somebody to take away from today's conversation?
Having the backup of that quantitative data that stands the test of scrutiny, that you've evidenced your conclusions on. If you've got that in place and you can show it, you can build trust.
I think I'll answer it in a slightly different way. I think the quant stuff, 100%. The thing I will say is about a mindset thing. Especially if you're new into that C-level type role, it's having a peer level, go into the mindset of it's a peer level conversation with the other people who are sitting around that that notional table, right? Your commercial folks sitting next to you and the other folks there. You've got as much to bring to the party as they do. You're not the supplier to the rest of the business. You're a peer, and think about it as a peer to them, or how we collectively are trying to solve these problems for the business. So the data and stuff is important, absolutely, but just doing it from you're saying something, they're saying it back, and that equal level of importance, I think, is just a good mindset to have.
Fantastic. All right. I will bring Hannah back in to close us off.
There's one more question I noticed, Will. If I don't know if we have time to answer that, just on the main chat from
the main chat. Yeah. So Hannah, stay with us. You're more than welcome. We're all friends here. So the question: what talking frameworks do you recommend for communicating? Just a quick one.
Ooh.
Whilst you're thinking, Darren, do you want me to?
Yeah, go for it.
But buy you a second or two and do something. So Radek, I'll try and interpret what I think you mean by what I am taking as talking frameworks for communicating. Two things. One is listen more than you speak. So just ask the questions to really understand what's going through. There's a thing in sales called spin selling, which if you're not familiar with, I would recommend looking into, which is about asking situational questions and then honing in on the thing. That can be massively helpful. The other thing is a plug for a very, very old book, but I plug it to everybody who's ever worked with me, called The Pyramid Principle, which basically says start off with the situation overall, then talk through the complications around it, then talk through all the sort of course of action around it. In the few seconds left, nothing more than Google Pyramid Principle, Barbara Minto, and try and learn a little bit around that, which I've found possibly the most useful course I've ever done in my entire career.
I might do that. A framework that our product managers use quite frequently is to be able to answer: who do we serve, why do we serve, what do we serve, when do we serve? And they kind of keep that in their head and use that to structure how they're talking about customer problems.
Interesting. Okay. Brilliant. Hannah, if you want to jump on again. There we go.
Hello, everyone. So thanks so much, Will, Darren, and Ray for your time today. Really appreciate it. And thanks everyone who was watching and asked your questions. We run these CTO Craft Bytes all the time, so check out our website for the next one. Will, we'll be seeing you at CTO CraftCon London in March. Very exciting. And so until then, everyone, we'll see you next time.
Cheers, everyone.
Cheers.
Thanks, everybody.